All right, people, T-Fade here. Welcome to the $500 portfolio challenge, Robinhood challenge, that is. So I'm just making this broad overview video on the strategies I'm going to use, the strategies that really professionals use. We're going to be using the same ones, and how we're going to get this money. So, hopefully, the people that are watching this can benefit from this information. Hopefully, we can get some new guys using advanced strategies and use that to their advantage. Yeah, so these strategies are the strategies that like the pros use, and it seems super complicated, but it's not. I'm gonna have to make individual videos on each of these strategies probably. I know you guys are gonna have a ton of questions, but I just wanted to make this video super quick. I don't want to drag it out too long and get bogged down with the minutia. So first of all, get yourself a Robinhood account. If you don't have a Robinhood account yet, get one. Please use the reference link in the description below. We'll both get a free stock, and that'll help us both, obviously. And when you do sign up, or if you've already signed up, what you're going to need to do is update your risk profile and answer some questions. Now, you're gonna need to lie. I don't want you to lie. I don't want you to blow up your account, but they're trying to save you from yourself, basically. So when they ask you, have you traded options, say yes. How long? Forever. And your risk tolerance, it'll ask you if your price goes down too much, what would you do? And a more experienced trader would probably add to his position at that point. Probably. Anyway, you need to be able to trade options for what we're going to do on this channel, and you also, more importantly, you need to be able to trade spreads. Now I'm going to try to explain what spreads are in this little short video, but we'll go through it more in detail later. But you need options, you need spreads. We'll also be buying shares here and there just to minimize risk, but we're gonna be taking some higher risk stuff, but we're also going to use probability and math on our side to do this. That's the whole point. The whole point is to make high probability, low risk trades to make consistent income with this system, and this video is already getting too long. All right, hopefully you know what stocks are. It's owning a little piece of a company. You buy a stock, you own one share. If it goes up, you make a lot of money. If it goes down, you make less money. So if you buy a stock for $50, it goes to 60, you're $10 in the green if you sold it. Otherwise, it goes to 40, you're down $10. Make sense? Okay, good. Now, options are the right or the obligation to buy or sell 100 shares of the underlying stock. So generally, that's the general overview. Now, so that's the right or obligation to buy or sell at the strike price. Now, the strike price is set. There's different strike prices that goes up and down. Like I said, the multiplier for options is 100 shares. So you have the right or obligation to buy or sell 100 shares. So a call option is a bet that the price of a stock will go up. A put option is a bet the price will go down. The easy way to remember it is call it up, put it down. Call it up, put it down, right? So we're kind of betting on which way the stock is going to go, up or down. So let's say a stock is $10. If you buy an $11 call, then another thing about options is they have an expiration date. So if your stock if you buy an $11 call on a $10 underlying, and it gets to $12 by expiration, you have the right to sell those 100 shares for $12 and buy them at 11. So you make $100. So on the other hand, if it doesn't get to 11, your contract is worthless, and that's it. So in order to pay for that right to buy or sell those shares, you have to pay a premium, and that's how much the option costs. Okay, so let's say for that $10 stock, the premium on it is 50 cents. So you buy a call option for a $10 underlying for 50 cents. Now the multiplier is 100, so 50 cents is $50. So that option, a call option on a $10 underlying, is going to cost you $50. Okay, now $50 is the most you can possibly lose on that call option, and that's if the underlying doesn't get to 10 or more by expiration. So it has to get a little bit above for you to do it, otherwise it would be worthless. Like, you'd just be buying and selling $10 worth 100 shares of $10 stock. Okay, so that's your max loss. You can't lose any more than $50 with the premium, whatever the premium is. But your gains are uncapped, like literally uncapped. You could buy a call option, an $11 call option, and the stock could go to 10,000, and you would be a trillionaire. So your gains are uncapped. Your risk is defined at the premium that you paid, but your gains are uncapped, which is, kind of awesome. The same is also true for puts. You can buy a put option on a $10 underlying. You buy a $9 put, and if the stock goes below $9, or go all the way to zero, and that you make the most. That's the most money you can make. So your gains are kind of capped, but you can still make a ton of money. So it has to get below. If you buy a put, it has to get below by expiration. So, but the thing is, the value of the actual option fluctuates up until expiration. So if you pay a 50 cent premium today, that option could be worth $1 tomorrow, which means you paid $50 for it, but now it's worth $100. So you don't have to hold it until expiration. You can cash out whenever you want. You don't have to wait until expiration and exercise your option, your right to buy or sell 100 shares. So if you buy a $50 option and it's worth 100 tomorrow, 150 the next day, 200, who knows, whatever it's going to be, it's going to be. You can sell it for whatever your risk tolerance is, whatever your target is. So hopefully that makes sense. Like I said, we're going to get into this more later, but just know when you're buying options, your risk is defined and your gains are basically uncapped. But the thing is, your stock, the underlying, has to move. It has to get to your strike price or above or below it. So the stock has got to do something for you to make money. So what sets the price for options, what sets the price, what sets the value, so what sets the premium, all of this is a bunch of crap that we can get into later called the Greeks. Okay, there's several underlying factors about options called the Greeks. Now the big one is delta. So delta is like how much the stock will change if it goes up $1. Like how much the value of your option will go up or down if the underlying price goes up or down $1. Make sense? Now gamma is sort of a multiplier on delta. And like I said, we'll get into these later, so don't get hung up on it. But gamma is sort of a multiplier of delta. So if delta goes up $1, and then for the next additional $1 goes up another delta plus the gamma. So it's sort of a thing. All right. Yeah. I got some notes here. Sorry. Now one of the other Greeks, a big one on option is theta. Now theta is like time decay. Like I said, you pay a premium for the option and then there's an expiration date. So if your option doesn't get to the strike price by expiration, it's worthless. It's worthless. You lost all of your premium. It's done. And theta determines how much less it's worth every day up until expiration. So it's like it's withering away, just eating at your profits, which is why we kind of want to get in the money and sell it. Now, here's the other thing is, who do you think gets that premium that you paid for the option? Well, the seller of that option gets that premium. So you're betting him that the price is going to go up or down. He says, okay, I'll take that bet. But to book your bet, I need a little bit of cash. You got to give me some money to make that bet. And that's where the magic happens, because there's essentially 5 different directions, 5 different ways a stock can act, right? It can go up a little, it can go up a lot, it can go down a little, it can go down a lot, or it can stay the same and do nothing. It can just trade sideways. So as a buyer, you have got to have it go one way. It has to go up or down a lot depending on whether you have a call or a put. As a seller, this is where theta comes in. As a seller of the option, you make money if the stock does 4 out of those 5 things. So if you sell an option, the price can go up a little, it can go nowhere, it can go down a little, it can go down a lot. So if you sold a call, the only way you lose money is if it goes up a lot. So it's a way higher probability. But the problem is, if you're wrong, you're on the hook for 100 shares of that stock. So it takes a ton of capital to do that. It's a little bit of money for a ton of risk. And if you have 100 shares of that stock, it's probably fine. But if you don't, guess what? You're on the hook to buy or sell 100 shares of that stock, and if you don't own it, you got to buy it. All right, so bringing this home, this is where we get to spreads. So we don't have 100 shares. We only have $500 in our portfolio, so we don't have 100 shares. So, but we want the high probability plays, right? So we want to be sellers. We want to be net sellers of options. So what we're going to do is, listen closely, we're going to sell an option closer to the money, the strike price closer to the money, which is where the stock is trading right now. Sell an option closer to the money, and then we buy an option just a little further out of the money. And this is called a credit spread. Now, the spread is the difference between the buy and the sell of the option. And that spread is the most that we can possibly lose. So now we just defined our risk. And so we defined our risk, and we know how much we're gonna make, because we get that money as soon as we sell it. It's a credit. We get the premium for selling that option. And then we use a little bit of that money to buy protection on the other side. Now, here's another great thing about selling options is you know the probability of making money. It's loosely related to delta. So if there's a 15 delta, say there's a 15 delta on an option, that means there's an 85% chance that stock will finish out of the money and that option will expire worthless, and you get to keep all of the premium. That is the magic. And this isn't some crazy math that you're going to have to do. It's all right there in the Greeks. Like, we already know. And on Robinhood, it doesn't even use you can see the Greeks, but when you go to sell an option, it has a percentage right there next to it. It says 85% chance of profit or 70% chance of profit. So we know right off the bat what kind of risk we're taking. You can sell 85% risk, 85% chance of making money options, and all the stock has to do is not get there and you make money. So that is the basic strategy. I know it's a lot of information. I know it's kind of confusing, but I promise it'll all get more clear as we start making trades, And as I'll do more videos, like getting a little bit more in depth, but just theta is our friend as net sellers, as selling options as net sellers. Theta is our friend because every day that option's worth a little bit less and a little bit less and a little bit less to the buyer, but worth a little bit more and a little bit more and a little bit more to us as sellers, as net sellers. So that's what we're going to do. That's what we're going to use. We're going to use credit spreads. We are going to take a little risk and buy and sell a few options just to kind of juice it up, keep a little skin in the game. But that is the overview, and I think I got everything. So let me just give you an example before I wrap this up. So let's say we sell a credit spread for that $50, the example we had earlier. But then we're going to buy an option just outside of that, and that's going to cost us $20. So our net credit is $30. So we get $30. And if that option doesn't get way out of the money, or way in the money, I should say, then we get to keep that $30. Make sense? Okay, that's it. Anyway, those are that's spreads. That's how we're going to do it. That's how we're going to do things. If you guys want to follow along, awesome. I'm not a professional. I'm not a financial advisor. All the information contained herein is just educational and entertainment purposes, blah, 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 blah. I probably should have said that in the beginning. Anyway, I'm going to end this here. It's way too long already. Please ask questions in the comments and let me know what you guys need clarification on and what I can do to make this easier to understand. I know probably drawing some shit on the screen is probably going to help out a lot, which we'll do. I wanted to knock this out, get the channel live, show you guys the first day of trading, and yeah, that's going to be it. Until